Broker Daily Uncut.
Broker Daily Uncut.
News, views and opinion about what's shaping Australia's mortgage and finance industry.
Welcome back to another episode of Broker Daily Uncut. I'm your host, Julian Barnes, and as always, we've got your favourite brokers, Eva and Costa with us today. Guys, how are you? How's your week been so far?
Yeah, good, Julian. Good to have you in person today.
Yeah, I'm not screened this time. I am recovering. I'm sorry in advance if I cough at some point, but I promise I'm not contagious. We're back on track, and obviously it's been a great week as well. So what about you guys?
Good. Look, we both had a bit of holidays.
Yes.
School holidays, and back at it now.
Back and refreshed.
Yeah, it's cold in Sydney.
It's very cold in Sydney. You've been up on the Sunshine Coast, which sounds a lot nicer. Maybe the house prices up there will be popping off after this. I did see some stuff about that, actually.
As a broker, you cannot go anywhere without checking the price.
Realestate.com gets quite a workout when you're on holidays. You're just like, how much does that cost?
Yeah, what's the yield? What's this? Yeah. What's that? Like, on a weekend, can we go to an auction? Yeah. Mazda's like, no.
Yeah, that's like me. Even in Sydney, I see an open house. I'm like,
that's
may as well check
I've got
that
nothing
out,
else to
see
do.
what it's like. Yeah, maybe go to the auction. No. Well, speaking of auctions, we've seen a bit of a rebound this week in terms of auction clearance rates. I think volumes are down. So 1,300 properties went under the hammer, around 8% lower than the same period a year ago. But we've kind of seen a bit of a rebound. So we've got clearance rates rose, preliminary clearance rates, I should say, rose to 54.8%, the highest level in nearly 2 months. Still a buyer's market, I would say, but I mean, it's a trajectory in a different way. Guys, have you noticed any kind of change in the conversations you're having, or is it kind of the same old and it's just a slightly lower volumes that's kind of creating this right now?
Yeah, I think lower volume. Vendors or potential vendors who don't have to sell will probably hold and wait. I guess there's also a bit of the vendors' expectation that has adjusted to the market, where people, always think their little shack is a castle and trying to. No, but it's
true. It's
what
true. We always value everything higher than what the actual market actually is willing to pay for.
Especially if it's a home, people just love it. They have hard time, they let it go, and they, so obviously there's probably a bit of that. On the other hand, our first home buyers, I feel like, don't want to catch a falling knife. Yes. And I also
it's difficult,
holding back.
Right? Yeah. Because you might see things tick up again at any moment. But I have noticed in conversations the first time buyers are definitely holding back right now. As you say, we've talked about potentially going into negative equity, particularly if you're in one of these schemes.
And I think that plays a big part because you're at 95%. Listen, not all first home buyers are going at that 95% mark, but vast majority are. And, if house prices are going to come back a little bit, they're going to negative equity. And it's just putting a lot of people on the sidelines. Like Eva was saying, the stock that was on the market is quite low. So, less there. It went up a little bit. And again, we're not talking about massive. It might just be an uptick this week. Yeah. I guess we'll see what the following weeks.
I mean, what's interesting is obviously there is uncertainty. There's worry that, interest rates could go up. There's worry that house prices can go down. But the banks are kind of going the other way. So a bit of information here. Some of the lenders are cutting mortgage rates, fixed rates, despite expectations of further tightening. So I think there was 18 lenders that have reduced at least variable home loan rates since the May cash rate hike. So you're seeing with 40 lenders now offering at least one variable rate below 6% and 15 advertising rates under 5.9%. So it's kind of going the other way in terms of how the pricing is. I don't know, is that more of just an adjustment to higher rates and they're kind of bringing them back into market?
And there's also, I guess, what the budget has done is there's less investors, obviously, able to borrow money. Banks would be hurting for business. If you look into the details of what those variable rate decrease are, it's also very specific to LVR type of property. It's not for everybody. So when we have somebody say, hey, I've heard that there's a rate under 6%, it's pretty much nobody that can get that.
I would imagine that's quite a low LVR as well. It wouldn't be an 80% LVR with a 5 in front at the moment. So Yeah.
So it's not figuring. It's more of a kind of market, kind of bringing it back in for specific buyers, which are not
and
necessarily.
listen, there are
going
probably
to.
some people that do have those very low LVRs. Investors, tend to cash out when they can, so they're usually hovering around the 80% mark.
Yeah. Right.
Yeah.
So there
if
would
you
be
want a 5 in front,
unoccupied rates.
and owner-occupier rates as well.
P&I, low rates, probably no offset.
Yeah.
And the bare bones.
Those vanilla
Bare
deals
bones.
that
Yeah.
every broker is trying to find, but don't necessarily arrive.
Where are they? Where are they?
But I think it's a good sign that they are even bringing down suffing, which
Yes,
means,
Yeah.
and it shows that, if there was people going towards the banks right now, they wouldn't be dropping rates. They wouldn't be competing like that because they're going to be like, well, we've got enough people here to sustain what the current rates are. But that just shows me that they're bringing them down. And again, they may
It does
be
show a certain level of confidence, right?
Yeah, and they probably,
It's low risk.
they're
Yeah.
after business as well.
Yeah.
It's not uncommon where we're getting phone calls from BDMs and stuff like that, asking, what's going on. You haven't been sending a lot of loans to us. So they are vying for a lot of business. And, it's a good thing. Lower rates, regardless of what it is always a good thing.
Yeah, and on that investor side, I'm interested in this. This isn't quite the story that the government told us a few months ago when the budget was released over rents. I can't remember. It was $2 or something.
$2 a week, yeah.
$2 a week.
Yeah.
So we're seeing rents lifting over. This is Catality's rental review for Q2 of 2026. Shows rents lifted by 1.6% over the June quarter, moderating from the 2.1 increase recorded in March. However, this annual rate of growth accelerated to 5.9% in Q2, up from 5.7% in Q1. There is a lot to unpack in these rental figures, and not every city is the same, not every region is the same. But obviously, how is that playing for investors right now? How is that playing in the conversations in the serviceability? Are you seeing anything kind of playing out there? Because obviously you've got interest rates, you've got complete overhaul of the way that kind of the investor market is going to work. But at the same time, I guess, is this a result of that, or is this more of an incentive, let's say?
Well,
There's a lot there.
like in regards to the rents going up, I think we all sort of knew that was going to happen once they got rid of negative gearing and the capital gains.
The government didn't.
And listen, everyone said it from the get-go, $2 per week. That just was never going to happen. And listen, there are pockets where, it's not going up as much, but overall it is giving us a picture that it is going up. Now, if your rent is to go up, what is it, $204 on average per week, that's $10,600 per year extra you'll need to pay in rent. Now, your wage will need to go up just over $20,000 to pay that with after-tax money.
Yeah.
How many people's rent are going up? I mean, how much people's wages are going up?
Yeah, that's over 5 years. The cumulative effect is an average of 204.
And
but
that's
obviously
just to cover the rent.
Very different depending on what city you're in, right?
Yeah,
So
of course. Yeah.
I think Sydney, followed by Hobart, has recorded the lowest rents. Let's see. So Sydney followed by Hobart, which recorded the lowest rent at 632, but the overall median national dwelling rent is 705 a week, which obviously is a large burden, particularly if you want to build up a deposit on top of that as well, right?
Well, yeah, it's eating into your deposit. And like I said, any pay increase that you're going to be getting is going to be going to obviously higher grocery bills. And also your higher rents.
How does this feed in terms of yields then? Because the yield data is quite interesting as well. So gross rental yields have gradually started to trend higher. So the national dwelling yield moved up to 3.7% in June and increased from approximately 3.5% at the end of 2025. Obviously, as you just mentioned, we've got all these kind of budgetary constraints on investors, but then yields are also ticking up.
Yeah, but remember the rates as an investment is like 6.5, let's say.
Yeah.
So if you've got a yield of, let's say, 3.7.
And you can't negatively gear.
It's still a huge gap in between. The other thing we see is, and obviously the scarcity of properties in some cities, like I think in Darwin, it's only 0.1%.
This is really interesting. Yeah. So
that's so low.
So that's why the yield is so high at 6.1%.
Yeah.
So investors, we've had this chat about, okay, are they going to go to new build or are they going to actually still buy established property, well, they might actually just change altogether the type of property they're buying with units where yield are always a bit higher because people can't afford to rent houses anymore. And 2, they might just go into cities like Darwin or regional where the yields are just higher.
Yeah.
We haven't had many discussions with investors considering buying new build or construction.
Yeah.
They're more like, okay, where can I get a property that will work for my finance?
Really?
Cash flow. So it is yield and it is location.
That's so interesting. Is that, I don't know how much you know the kind of reasoning behind that, but is that because uncertainty? They're not sure whether the policy is going to stick. It's cash flow, right?
The more negative gearing, you need to make up the numbers somehow.
And the numbers don't work with a new build, or?
Well, they potentially would. Cash flow is better, but long-term growth is not as
there.
good.
Yeah. What's the yield like on them? Is it pretty similar, or?
It depends where.
It could vary quite a bit.
It's probably a bit better than established property.
But again, with the newer build, you're actually paying that premium because everyone wants, the brand new fancy sort of thing. And then your strata's quite high in those new buildings. If it has pool and gym and all that sort of stuff. So
they're actually in the media, I think 2 days ago, saying there's such a shortage of skilled workers in the construction industry.
Yeah.
That if someone buys a block of land today, could be years before it's actually built. And then this whole issue of bringing migrants to cover this.
Well, they need the homes as well, right?
And then they need homes as well. So it's like constantly chasing.
I saw that we did a story in Perth where we looked at, obviously Perth prices have been moderating. They're still growing, but they've moderated. And I was interested to see what the impact on the ground was. We've also seen kind of the houses sitting on the market for longer. We've seen more houses on the market. So I was interested talking to Perth brokers, like, well, what's it looking like on the ground? They're like, well, the fundamentals are exactly the same. There is a scarcity of people to build new houses, and we're trying to build more houses. And then the more people that are brought in to help obviously contributes to needing more housing. Yeah. So they were like, the fundamentals are identical to as they were. Like, sure, there are some slight differences in the economy and uncertainty, but the reality is if you have this many people with this many homes, there's always going to be a demand. But
also inflation is a big part of it is the construction cost.
Yeah.
So I guess you need to build quickly.
Well, we've been saying it probably since COVID. We've been saying that obviously building costs went up quite significantly during COVID. But even now, when the government said we need to build more homes, that's why we're getting rid of negative gearing and all that. And we've discussed it a million times, and on the SBI podcast as well. The fundamentals, like you said, Julian, it's still there where we're just not building enough. The red tape to get something up and running is just absurd. Yeah, I don't even know why builders would still consider doing it, because it takes that many years and you've got to hold that property for so long.
I agree,
that it starts eating into your, into your profits, and then throwing building costs skyrocketing. You just think like, I can hold it now. I'm not going to start for 3 years. Building costs are going to go up by another 10%. So there goes another 10% of your profits. And it's just a vicious cycle that needs to be solved before anything else.
Yeah, I remember talking to a broker in Broome, and one of the most remote parts of Australia, and they're like, "We've got land. Like, it's not like there's no land.
They're definitely
to build
not short
on.
there.
We've got demands. There's plenty of demands, but there's just it's just the hurdles to get the properties over the line are too difficult. And when land is released, the demand is huge. But
I've spoken to people who want to build apartments and stuff like that. They just said the red tape and the hurdles that you have to get over from government it just delays it so long. But anyways.
There we go. Guys, we better take a quick break there, but back in a sec. Welcome back to Broker Daily Uncut. Now, before the break, obviously, we were digging into the clearance rates, into rentals, all that stuff. But there's obviously another big bit of news that's come over that we've done this week on Broker Daily, which is on open banking and the consumer data right, which is coming into the non-bank sector. Now, this has been planned for a while, obviously. This is just the latest parts of the process. So eligible non-bank lenders are now required to begin sharing their product data through consumer data right, including interest rates, fees, charges, features, eligibility criteria across, I think it's home loans, personal loans. It's not everything. So home loans, personal loans, business lending, buy now, pay later products. So there's a few kind of there's a few things that the Treasury, I think, carved out. They said it's too complex and too difficult to kind of share. this is just the first phase. So I want to ask you about the second phase in a sec. But obviously what they hope this is going to do is it's going to allow greater competition and greater comparison across the non-bank sector. Obviously, it's already been rolled out across the banking sector. So I'm interested for you guys. I don't know how much you guys have already interacted with CDR and with open banking and how it kind of affects your lives. But for you, how does that sound in terms of have you used open banking and how does this kind of extra rollout into the non-banks help?
We do request all our clients to share their information through open banking. Obviously, there's always people that won't do it. Or people that are with non-bank lenders and not everything could come through. So
how easy is it to get data anyway from
it is great. It's really easy, and then they help us right away to find what the actual loan balance limit, what the interest rate, what the monthly repayment, what's their living expenses, which most people, if you ask them, they just don't know. They can't find the information. I had a client recently that had to call their non-bank lender, ask for a statement that apparently they don't do, had to pay for a statement to be mailed to his house.
Yeah.
To actually know what was his current balance and interest rate. I just found that amazing. It's like,
that's crazy. Yeah.
How is it still
I think
possible?
there's more work involved sending it off than just telling him.
They charged him.
Yeah. That's interesting, isn't it? Yeah.
So obviously, and that took, maybe 2 weeks for him to get that letter because it's not, they took their time, of course. And they still do the same when you close a credit card. Sometimes they will mail the letter of closure to you instead of just sending an email. Yeah, it's been closed, which delays things.
Yeah.
When sometimes it's urgent. So obviously having the data there in an instant will definitely help the speed of application, the accuracy of the details we share with the banks when we apply somewhere else.
So that part, obviously, the consumer dating where you're sharing that is going to be rolled out 9th of November to some, and then the larger providers 10th of May 27. But it's interesting the growth as well. I didn't realize how fast this is growing, because obviously something I've heard from brokers in the past has been that clients are a bit like, they don't understand what it is. They're not quite sure. They're not quite sure if it's secure.
They don't want to put their password in.
Yeah, exactly. Yeah. But then you see, according to the Australian Competition and Consumer Commission, the ACCC, more than 1.3 million Australians are now using CDR, with adoption increasing by 135% over the past year as the open banking framework continues to expand. Is that something you've also noticed, that clients are coming to you being like, I have this, that I have this tool? Is that? Yeah,
like Eva was saying, it makes it easier, not just for us as the broker, but for the client as well. Like the client otherwise are going to have to go into, they may have 4 or 5 loans with 2 or 3 different lenders. They're going to go in the apps, print off, download, send off. And then sometimes they send us a statement, which was for 3 months ago. And it's like, well, we need the updated one. Yeah. And it's just, it eliminates a lot of back and forth, which is good because you just want to get the loan sorted, do their assessment and give them the correct details. Because sometimes you can get numbers lost in translation as well. Whereas the open banking just makes it so much easier.
And the way we used to do it, that would share information at a certain amount of time. With open banking, you can decide to share for 3, 6 or 12 months, which means we don't have to constantly asking for updated data.
Yeah, absolutely. But one thing that I kind of picked up, I talked to Tony McRae from Bluestone, and it's something that struck me is obviously in the banking space, obviously there is always nuance and complexity in any deal, but the non-bank sector specifically often caters to that. And the whole point that sounds like it could contradict the kind of aim of open banking CDR of standardizing data, of making it comparable, making it applicable to all scenarios. One of his quotes here: non-bank lending often involves nuanced scenarios, whether that's self-employed income, alt verification, or unique credit histories. Translating that into standardized data sets to work seamlessly within CDR frameworks is not always straightforward.
Correct.
Do you think that will be a hurdle when you try to start bringing in these kind of other lenders?
I think commentary then becomes pretty important in a situation like that. Finding out the background of it.
And what do you share then with the lender you're applying to?
Yeah.
That's what can be tricky sometimes.
Yeah.
You just, and listen, there are some things that get lost, but with technology, I think you can solve a lot of those problems at some point with something. But like I said, I think commentary just plays a much more important role. Finding out, if the product is a low doc loan or something like that, why was it a low doc loan?
Yeah.
What year were you using? Did you use BAS? Did you use accountant letters? And just finding out more information and then taking it from there.
Yeah, and another aspect of it that I want to ask you guys about, because obviously we've talked about fraud plenty of times on this podcast, but it seems like this is a good way, not all, forms of fraud, but particularly that kind of document level frauds, it takes out, right? Like, how can you falsify your income, for instance, when the banking data is shared directly? How is that going to change your lives in terms of picking
I guess,
out kind of stuff?
well, look, we always supposed to, for compliance purposes, to get a second form of income verification. So you get a payslip, you should get a bank statement showing the credit going in there. I guess if someone wants to be very clever about it, can always make some credit for a certain amount of time that matches basic. Like fraudsters, I guess, are getting quite
smart and finding ways around things.
But obviously, that's another way to check it.
Yeah, so it will be another kind of side to it,
Checkpoint,
I guess.
yeah.
Yeah, absolutely. Guys, we better take a quick break there, but we'll be back in a moment. Welcome back to Broker Daily. Now, it's a perennial topic on this podcast, but it's so interesting because it is moving quite fast, which is, of course, SMSF. So I went to the launch of new white label products from AFG in partnership with Pepper Money. That's a long-term partnership. They've been doing resi with them for a long time, but they're moving now into SMSF lending and also commercial lending, a range of commercial lending. I want to talk to you about SMSF today. Obviously, this launch has come after the ban on residential, so this is specifically in commercial, and it's something that, this is not a new idea, but it's something that I've heard brokers talk about increasingly, is this idea of, particularly self-employed borrowers with an SMSF, if they have a premises and go through the right kind of stages, you can essentially rent yourself your property through your SMSF, right? And obviously that's not a new idea, but it's something that's kind of gaining in traction. And I guess when you see AFG and obviously Mortgage Choice as well, partnering with Pepper to introduce new white label SMSF loans, SMSF's not dead. It's just kind of changing character, right? Yeah. Guys, what have you been hearing in your conversations with your SMSF clients right now?
So look, it's been a huge couple of weeks, 3 weeks, with SMSF being, I don't know what's the percentage increase, but
we've just been flooded.
Hammered with SMSF. So people want to get in last minute. People that didn't have SMSF. And
at this point, it's all resi, right? There is
there's no point to rush.
There's
no point to rush for commercial. That's still happening. So we got a huge amount of those. We do obviously see issues coming with that in terms of how the SMSF is set up, what buyers agents are doing to find property in a rush, banking, or I should say non-bank lenders delays.
Rollovers and stuff.
Rollovers,
and it's getting closer and
it's getting closer. So
right?
the 9th of August is the latest day you can sign, which is I think on a weekend.
Yeah, it's a Sunday, I think it is.
Yeah.
So you have to sign by the 7th or whatever it is.
Yeah.
So it's 3 weeks away.
How's that feeding into buyer decisions right now? Like, is it because you kind of have to choose a property like now?
Yes. I got a feeling a lot of people are just going to be picking up a property for the sake of it, just to get within that, because a lot are using buyer's agents, and if you go through a buyer's agent, it does usually take a bit of time for them to go through the process to find out what you want and then go actually outside and execute it. But they're turning things over quite quickly. Are they sending the best property? I don't know. That's not for me to say because I do the finance side of things. That's up for the buyer's agent and the client to decide.
We do see a lot of question rates though about the type of property. So obviously we can't advise client on is it a good property to buy. But property coming back with sometimes valuation issue, pest and building issues,
leases which are signed before contracts are signed.
Yeah, I said
far under rental appraisal.
This makes your life difficult.
It does, because we've got to deal with the afterflow of those decisions, and sometimes you can find a solution, but a lot of the time you can't as well. And then that puts the client into a bad position as well.
Yeah, absolutely.
Well, think about it. If you're a buyer's agent that I don't know, one-man band that does like, I don't know, 3-4 properties a month, all of a sudden you might have to do 10. You don't have the network or your time to actually find 10 properties, go and inspect it yourself, do the whole
Yeah.
So yeah, we do see a lot of properties that would not normally be presented to client, I think.
It's funny, isn't it?
And clients knowing it.
and some do know it.
It's funny, isn't it? Because I remember before the ban on the Resi ban, I'll call it, I remember there was some submissions into the budget, the Senate committee, that were saying the worry is that now there'll be SMSF is going to have issues, and obviously it's short term, but there is obviously that concern around how that works in the long run in terms of serviceability, in terms of the property market, how that works. But I guess it remains to be seen.
Yeah, well, people tend to hold SMSF properly a long time. So hopefully, I guess in the long term, it's still
it was always
still
an
decision. But the thing is, it's your retirement fund.
Yeah, it's your retirement.
You want it to be a good decision.
How was prior to this decision and the policy change? How was the trajectory in terms of SMSF demand and interest?
It was growing anyway.
It was growing anyway.
I'll just quickly say this is prior, so this is including residential, but Pepper Money reported close to 60% year-on-year growth across commercial and SMSF lending business.
Yeah,
which is huge.
Yeah, so that happened because of interest rate going up and all the restriction around investment lending. People couldn't afford anymore to buy investment property. SMSF was a way out of that and still keep going, building portfolios. So that was definitely growing for a good year and a half. More and more lenders were doing it. AMP came back. Late last year. So that was definitely business booming there, which has been put to a stop.
Yeah, absolutely.
Commercial is still available, and we'll see more of that.
Yeah.
I've even had discussions with clients who, because they've engaged me in the past week, telling them, hey, we're running a fine line. And even a couple of them have even said, worst case scenario, I'll pick up a property, a commercial property, if it doesn't work out in my SMSF. So they are thinking commercial. I think there'll be an uptick in commercial lending for SMSF because I don't think it's going to be dead in the sense where no one will now go to it. But they might pick up a nice little warehouse or something like that in a strata titled block that they can get for a few $100,000 just to diversify their portfolio. And once they're capped in their personal name, go to SMSF, buy something commercial, and then come back to personal name and go again.
Yeah, absolutely. And then I wanted to ask you guys, because you were telling me a little bit about this is on another note, on bank retention strategies and stuff. Now, this isn't new, but I'm interested in what you guys said. So I guess just to round off this episode, can you tell me a little bit more about what's happening what you've seen banks doing to you?
They're being a bit cheeky.
They're going hard trying to retain clients. And we'll discuss it off there. They have been doing this forever. But when times are good, I think they just drop the ball because a lot of business is coming in to make up for that drop off. But now there's not as much business coming through, so they need to keep clients. And they're going pretty hard with retention. I know ANZ offer $2,000 cashback.
Cashback's coming back. Yeah.
Well, Eva was saying she thinks it will, and I probably would agree with that. They're giving bigger discounts.
I remember the ANZ because I think on the Advisor, they talked to some brokers that said, it's so frustrating when you go through, you do all the legwork, and then ANZ says to the client, oh no, if you stay, you get 2G. And then everyone's like, okay, never mind.
Especially when clients have tried to get a better rate. Like 2 weeks before. And they're like, okay, well, I can't get anything. Let's refinance. You refinance them, send a discharge, and then, okay, no, we'll match it. It's like, come on. It's really frustrating. And for the clients as well. Because they had to do
they had to go through all the effort.
It's not being upfront with what you can offer straight away, 100%. I guess. Yeah.
And I feel like, because there are few that I've done with cash outs, so investors can purchase a property, and then the retention team going, we'll give it to you, but based on servicing. And then they're like, servicing will be easy. I'm like, but you're not servicing with that bank, you will not get that money. So they're being, like Eva said, they're being a bit cheeky in the way they're doing things, but we have seen
in the past as well, like I know that I could have put this client with the bank and I know for sure that it would have been declined, if that's right. And then that same bank retaining the client, offering what I know I couldn't get.
Right.
So they are pushing, servicing boundaries and everything when I know, it's just not working. It just wouldn't work.
Yeah.
So,
they're willing to go that extra mile to kind of keep the
and the
client.
cashback will come back because we see an investment market has and will shrink.
Yep.
So there would be a refinance war this next 6 months for sure. And that will happen with SMSF because that's it. The pool of SMSF resi lending is that. There's no more. So they will fight for refinance business and retention.
Of course. Yeah.
It can be a bit tricky because some of them do have large exit fee.
Yes.
For SMSF.
Yep.
Really?
Even if it's resi, yep.
So that will kind of keep people in kind of one
place,
in
for
one lane.
2-3 years, I think some of them.
Yeah. Yeah, I think 3 years max.
Yeah, so that keeps them there. But after that, it's
do whatever you want.
Yeah.
You heard it here first. Refinancing war on the way. Guys, we better leave it there. But thank you so much, as always, for joining me. I like to always ask you guys where people can find out a little bit more about Finni and what you guys do. Where can they go? Yeah,
finni.com.au. You can find there ways to book an appointment with a broker or chat to Lizzie, who is our new customer excellence person. If you just want to have a quick chat, you can call us. Yeah.
Excellent. Well, that's all from us at Broker Daily this week. Thank you very much for tuning in and see you next week.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.